Hi, Shae Russell here from Fat Tail Media. And joining me from the other side of the world is none other than Jim Rickards. Jim, how are you today? Or tonight, where you are?
Yeah, tonight where I am. Good morning to where you are. I'm great, Shay. Great to be with you again.
Now, as usual, I always love talking to you. And we made a joke off camera that we could have a 4 or 5 hour conversation, but unfortunately, we don't have that much time today. Now, the sole purpose of why I wanted to talk to you today is actually because of your new book, The Great New Depression, which I picked it up the minute it was delivered on my doorstep. Took a little while to get here from
Right.
America. Australia Post is a bit slow at the moment, and was barely able to put it down. Now, first and foremost, I just wanted to point out this. I believe already in the short time it's been available, it's already a bestseller, isn't it?
Yeah, we've been very fortunate. We were ranked as a national bestseller in the United States. We were also picked up as a Wall Street Journal bestseller, listed as one of the number 5 on their list of business books bestseller, and we were ranked the number 1 new release by Newsmax, highly ranked in our categories on Amazon, and we got 4.2 stars, which is not easy because there was a couple of trolls out there want to throw you a 1 star, but we're very gratified to see a lot of 5-star ratings come in. So, yeah, by all measures, sales rankings, the book is a bestseller and a success, and we want to, obviously keep that going. But it's a lot of people put a lot of work into it. I'm the writer, but we have editors and art directors and cover art people and media people, and it was a great teamwork. So we're very happy to see the success of it. Thank you.
Well, the reason why it is successful, now, I believe this is one of the first books to try and link the pandemic and the economic outcome together. I mean, there's been a lot of writing about the disease and what's happening. There's been a lot of writing about the markets, but you're the first person to at least link this information and get it published, aren't you?
Yes, this is the first book of its kind in that sense, and you're right, Cher. There are a number of other books out there written by doctors and clinicians talking about the virus, and obviously a lot of newspaper coverage, et cetera, about the pandemic. It's the funny thing is, but on the economic side, economists actually very few of them write books. They write journal articles. They publish in economics journals and give speeches and all that. There aren't that many who write books. There are a few public policy mavens, I'll say, who have written about the consequences of the pandemic and what the future may hold. Although I've looked at those books as well, they're kind of regurgitated globalism. Here, globalism is coming back now that Trump's gone. We can get away from nationalism. So those books are out there. But this is the only book that really connects the two. That does a deep dive on the pandemic, where it came from, how the virus acts, the impact it's had, et cetera, and on the economy, the what I call the new Great Depression and the prospects for the years ahead, including many of which could be intergenerational. I think we'll be feeling the effects of this 30 years from now, and I explain that in the book. And then you say, okay, there's the clinical, medical, immunological side, and there's the economic side. What's the connecting tissue? What's the bridge, if you will? And that's the lockdown. I make the point that lockdowns are a response to the pandemic. They don't work to stop the spread of the virus, but they do work to destroy economies. So the lockdown is the key to understanding exactly how the pandemic affected the economy. Obviously, there's been an effect, but you say, well, how and why? And the answer is the lockdown policies have made the economic depression far worse without any benefit in terms of the pandemic.
I'm actually glad you brought up the lockdown. And obviously, in the first few pages of your book, and if anybody actually saw the book that I've read of yours, it's full of highlighters because there's some great comments in there and some great quotes. But one of the points that you draw attention to very early on in the new Great Depression is that when we've had previous pandemics, governments didn't implement these citywide, countrywide lockdowns. Now, my question to you is, if China didn't fabricate the data and fabricate control of the disease via lockdowns of their major cities, do you think other governments would have followed suit, or do you think we would have avoided lockdowns?
I think we probably would have turned to lockdowns. And in chapter 2 of my book, I explain where that comes from, at least on the U.S. side, whether Australia was looking at, Italy and Spain and the United States and saying, well, we need to do that. Victoria obviously was barely affected. Melbourne was barely affected, but that was a little bit later in the timeline than the outbreak in Europe. So Australia at least had a couple models to refer to. But it's very clear that the U.S. had this lockdown plan on the shelf. This really comes out of the swine flu, the avian flu in 2005. And George W. Bush was president at the time. He was very concerned about it. So he read a book by John M. Barry, called The Great Influenza, which is about the Spanish flu of 1918, 1919. I read that book also as part of my research for the new Great Depression. And Bush was, we kind of got through that avian flu episode without too much damage, but he said, well, we need to be prepared for something worse. He was very influenced by the book. So he asked the CDC to come up with a plan. And again, without spending too much time on it, I talk about how the plan was developed by a complexity theorist at the Sandia National Laboratory in New Mexico, who was kind of inspired by his 14-year-old daughter, who had done like a toy model, and so he expanded on that. So these models with autonomous agents, and you can do them on computers, and I've done them myself, and I do them in financial modeling. They're valuable up to a point, but they break down and don't have much predictive value when you get into adaptive behavior. If you assume everybody's the same and the response is the same and it's black or white, you can kind of code that and watch how it develops. That's one thing, but people are not black and white. They actually, as soon as the government tells them to do something, they say, well, how can I get around that? Or how can I do something else? Or, probably Australians are as bad as Americans when it comes to this, just sort of working the way around things. So the point is that real world adaptive behavior did not conform to the assumptions in the model. Nevertheless, the study took on a life of its own. It was updated during the Obama administration. It was finalized during the Trump administration. So this lockdown plan really evolved over three presidential terms or administrations rather, Bush, Obama, and Trump. And so when a much more serious pandemic came along, they literally pulled it off the shelf. And as I said, it was a return to the Middle Ages. That's how barbaric and ineffective it was. But the point I make is that top scientists said so at the time. In 2006, I have a paper from D.A. Henderson. Now, D.A. Henderson is not a household name, but he's probably the most famous epidemiologist in history. He led the effort to eradicate smallpox in 1979. So there are no cases of smallpox on the planet Earth today. And he was the leader of that effort to eradicate. So I guess he knows a little bit about epidemiology. He won the Presidential Medal of Freedom, which is our highest civilian award, comparable to the Congressional Medal of Honor. And he was dean of the Bloomberg School of Public Health at Johns Hopkins University, which is our #1 school of health. So you can go no higher than D.A. Henderson. And he said in 2006 that lockdowns don't work. So we should have seen this coming. Today, there's an enormous amount of evidence now that they don't work. Now, I had enough evidence to reach that conclusion last spring when I started writing the book. So kind of in June, I updated it through October. The material is very fresh, but by June, I said, no, these lockdowns don't work, and the evidence was there. Since then, since I finished the book, enormous number of studies have come out and said the same thing. And now, of course, we have a lot more data. So in the United States, for example, we have 50 states. We never had a national lockdown. It went state by state. So each governor, each mayor could impose their own rules and we did. And some of them, so New York and California were extreme. Florida, I would describe as moderate. South Dakota, had no lockdown. They said, wash your hands and social distance, but it's voluntary. We're not locking anything down. And then around the world, the same thing. So Korea had a fairly, Italy and Spain and Victoria for that matter, had very extreme forms of lockdown. Korea and Sweden, I would describe as a moderate form of lockdown. Brazil didn't do anything initially. So now the results ran from 30 countries and 50 states. And what they show is that there is no correlation, none, between lockdown policies, strong, weak, or in between, and the spread of the virus, the caseload, and the fatalities. In other words, statistically, the conclusion is that lockdowns have no material impact on the spread of the virus.
But
however, they destroy economies.
I was about to say, that's got to be my next question is, it turns out that lockdowns have, catastrophic consequences for economies. And as you mentioned before, there are intergenerational consequences of these lockdowns. Can I get you to explain a little bit more about how, we're not talking about just our generation, but we're talking about, the next decade of uni students or college graduates coming
Right.
into work in the economy?
That's right. I'll use myself as a model. So I grew up in the 1950s and early 1960s, which was a very prosperous time in U.S. history. The economy was great. And I did not live through the Great Depression, but my parents did and my grandparents did. So I was raised with a depression mentality, even though I wasn't living in a depression. And we would, the newspaper would be on the lawn in the morning. We'd take the rubber band off and put it in a jar, because why waste a rubber band? We went around as 9, 10-year-old kids with our wagons door to door collecting tin cans and newspapers. We weren't doing it for environmental reasons. Maybe it was good for the environment, but we were recycling the tin because you could build airplanes and battleships with it. In other words, we had that prudent, frugal, depression mentality 20 years after the depression. That didn't change until the late 1960s, when our baby boom generation came of age. And then it was like, yeah, we all got credit cards and party and buy houses and get mortgages and all that. And then it became a much more consumer driven economy. But the point is, the effects of the Great Depression behaviorally, in terms of adaptive behavior, lasted 30 years beyond the Great Depression. And just to kind of amplify that a little bit, there was a study, and I talk about this in my book, conducted by an economist at the Federal Reserve Bank of San Francisco and several colleagues from academia. I believe they were University of California, but they were top economists. And they looked at a 650-year time series. Now, that's my kind of time series. I always criticize analysts, like, you look at 6 months, who cares? That you're missing too much. But they went back to the Black Death of the 1350s, and they looked at every pandemic since the 14th century in which 100,000 or more people died. So that was their baseline. And there were 15 of those pandemics. And by the way, the COVID pandemic is now number 3 on the list. The Black Death was 75 million dead. The Spanish flu was about 100 million dead. I'm looking at the board right now. We've got 2.2 million dead in COVID, but the third worst pandemic was about 2 million. So this is now the third worst out of the 15 I mentioned. But looking at those 15 pandemics with 100,000 or more dead, they found that, well, first thing, you never get back to normal. Forget normal. We'll survive. We'll get through it. Life will go on. It won't be the same. So normal, whatever you thought it was, is gone. But we get through it. But their question was, when do metrics like interest rates, unemployment, growth, et cetera, get back to something that looks like normal? And the answer from the data is 30 to 40 years. Not 30 weeks or 30 months, but 30 years. And that's consistent with what I just said about the Great Depression, which was in the 1960s, early 60s. We were living the way people did in the 1930s, not because the economy was just as bad, but because behavior had changed. And so, yes, you have a 5-year-old, girl, she's going off to school, and her mommy says, put on your hat, put on your coat, and put on your mask. And kids are adaptable, and they do put on their mask. But that's an experience that will stay with them the rest of their lives. They'll remember growing up with a mask on. And so it affects things. And so the point is, even when you have a quote reopening, let's say, I'm not saying this will happen soon, but you get to a point where restaurants are reopened and airlines are back on schedule and resorts are open. It doesn't mean that everyone's racing out to a restaurant. It doesn't mean that everyone's getting on a plane and going on vacation. There will be residual fear, residual concern, and change behavior, just what's called adaptive behavior, that will continue to affect the economy long after the COVID is sort of under control.
Just on that, when you're talking about the psychology behind the psychology driving depression like behavior, this is something you do actually really drive home throughout the book, is that a depression isn't defined by numbers. A depression is defined by how people behave within the economy. Now, could you just explain how you came to this conclusion? Because there's not many people who actually identify a depression this way.
That's right. Although one of them is John Maynard Keynes, and I quote his description. So I nicked it from Keynes, but I agree with it. And it's not all about numbers. And by the way, we got a very good book review just a couple of days ago in the Financial Times, and the FT picked up on this. They actually recited that part of the analysis, and as an author, I was happy to see that. I was like, yeah, this guy actually read the book and he gets it. But here's the long and short of it. So recession is numerically defined. A general definition: 2 or more consecutive quarters of declining GDP. So one bad quarter, okay, but you have 2, that's a recession. A few other bells and whistles, but that's about it. And we have a group called the National Bureau of Economic Research in Cambridge, and they're the referees. It's a private group, but when they say it's a recession, it's a recession. They say it's over, and that's widely accepted. And so you say, well, depression sounds worse than a recession. So if a recession is 2 quarters of declining GDP, a depression must be 10 quarters of declining GDP. In other words, it's like a really long, bad recession. And that's not the definition. That can happen. That's actually quite rare. But a depression is a very extended period of depressed growth, meaning you can have growth in a depression, but it's below trend, it's below potential. In other words, it's depressed growth. And for that matter, I think you can make a good argument, and I do, that the period from 2009 to 2019 had depression-like characteristics because, okay, that was a 10-year growth period. It was the longest sustained expansion in U.S. history. But average annual growth for the whole 10 years was 2.2%. And it clustered around that. There was never a 3% year during the whole 10 years. It never went negative after 2009. But, it might have been 1.8 or 2.7, but it clustered around 2.2, and the average was 2.2. Well, for all expansions post 1980, the average in the United States is 3.2. So right there, we're a full percentage point below trend. And if you think 1% doesn't sound like a lot, you apply 1% to a $20 trillion economy, compounded over 10 years, you're talking about $4 trillion of lost wealth, $4 trillion of wealth left on the table. Now, that was during an expansion. Now, bring that forward to today, my estimate is that we're in a second recession right now. The United States, that is. We had Europe, certainly. So we had a technical recession in the first half of 2020, 2 consecutive quarters, down 5% in the first quarter, down 31% annualized in the second quarter. Then we had strong growth in the third quarter. Fourth quarter, we won't know the number for a few more days, but it looks okay, but not great. But the point is, you're working off a very low base. So it was sort of down 31% in the second quarter and up 33% in the third quarter. And everyone says, well, doesn't that get you back where you were? And the answer is no, because the 33 is off a much lower base. It's 33% of a lower number. And so, but now looks like we're heading into a new recession. That's because the pandemic is back, never went away. But right now, the caseload in the United States is about 9 times greater than it was last April. So last April, March, April, May was the worst period in the United States. Except today, at the time, and we all thought, we're all locked down, quarantine, the world's coming to an end, et cetera. But today, the caseload is 9 times greater. The fatality rate is double what it was then. The reason the fatality multiple is less than the caseload multiple is because the therapeutics are better, but that's not a cure. It just means we're handling the patients better. But so it's much worse right now than it was then. Well, what are governors doing? They're locking down. Again, this is their default remedy. So they're locking down. No indoor dining in New York. California's worse. Gyms, nail salons, restaurants, bars, dry cleaners, they're all locked down or greatly reduced capacity, maybe 50% or less. Well, and people look down their nose at that because they see the stock market reaching all-time highs, which it has recently. But I make the point that the S&P 500, which is the major index, should actually be called the S&P 7 because there are 7 stocks bringing the whole index along, and we know what they are. It's Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla. Those 7 stocks, because the S&P 500 is what's called a cap-weighted index. Your influence on the index is based on your market capitalization. Well, those 7 stocks are 40% of the capitalization of the entire S&P 500. So if they go up, the index goes up. More people buy it, it goes up more. More people buy it, it goes up more. So it's sort of a recursive function, but it has bubble dynamics. I wouldn't say go out and short it, because it's like getting run over by an 18-wheeler going 70 miles an hour. I don't want to stand in front of that yelling stop. But I look at it, I step back and look at it. It does have a bubble dynamic to it, but it'll go some way. But the point is, that has nothing to do with the real economy. I've never seen the stock market so detached from the real economy. And when I say the
But
real economy, sorry, go ahead.
Oh, sorry. Might be a bad connection at my end. I apologize for cutting you off. It's funny you say that, because right in front of me, I have one of your quotes from your books. And if you'll just indulge me while I read it out. And something you point out here is our major stock indices are divorced from the real economy and relatively unscathed by the 60 million newly unemployed Americans and the near wipeout of small to medium enterprises.
Right.
Now, that's a staggering number. But as you just pointed out, the top 7 stocks on the NASDAQ are at all-time highs.
Correct. So people kind of look down their noses. They'll look at a restaurant and say, all right, you've got 20 wait staff and bartenders, and you've closed, but that's only 20 people, and you'll reopen, get hired back, and no one seems to care. Well, first of all, I care, and I guarantee there's 20 people who are out of work care. But but analysts who say things like that are missing a couple of things. Number one, that restaurant may not reopen. It may not be a matter of 3 months or 4 months or whatever, and then you reopen your doors. They're gone. They're closing up, walking away from leases, selling their equipment at fire sale prices. The jobs are permanently lost. Maybe they'll open another restaurant in another state someday. They're entrepreneurs, but not yet. That restaurant's gone, and those jobs are gone. Number one. Number two, it may be a small enterprise individually, but in the aggregate, those small and medium-sized businesses are 50% of all the jobs in the United States and 45% of GDP. So you're locking down half the economy, or at best, greatly reducing capacity. So if you take half the economy and cut capacity in half, by half, let's say, you've shut down 25% of your economy. How do you do that without a recession? Well, the answer is you can't. And that's why my forecast for the first quarter of 2021 is another recession, because we have a new round of lockdowns. So the aggregate is huge. And again, the stock market will go its way, although it seems to have hit a little bit of an air pocket in the last couple of days. But the real economy is suffering. Many of those jobs are permanently lost. And then there are ripple effects that take time to play out. So you shut a restaurant, well, then they don't pay the lease, they break the lease. Well, what happens to the landlord? Well, if he's not getting rent, how does he pay the mortgage? And what happens to the mortgage? Well, it goes into arrears. And then that falls on the bank, except the banks have packaged these into commercial mortgage-backed securities and sold them to you and me. So, look in your 401k account in the US, or any kind of superannuation account or savings account in the UK. And don't be shocked if you find, some commercial real estate mortgage-backed fund that was sold to you by some broker that's actually going to perform very poorly based on what I'm saying. So this could take a full year to play out.
Look, that's a really important point of how divorced, the stock market is from the economic reality. But a couple of things I want to touch on before we wind up today. First and foremost, we've got Biden in the White House now. So surely all of the problems from Trump and the pandemic and, his lack of response, or, whatever response he did that the mainstream media weren't happy with, surely with Biden in charge, everything's on the right track now, Jim.
Right. So here are Biden's policies. And I'll give them credit for transparency, because they've told us what they're going to do. First on the campaign website, now through a series of executive orders and announcements, et cetera. So we actually know what Biden intends to do. Now, he may not get everything on the list, but there's nothing on the list that's not detrimental to the U.S. economy. So number one, open borders. So they're stopping deportation of illegal immigrants. They're stopping construction of the wall. There are already large caravans marching north from Guatemala and Honduras. So they'll be at the Mexican-U.S. border in a matter of days. And so we're not going to deport anyone who claims amnesty, et cetera. So a lot of people frame this as a humanitarian issue, good neighbor issue. I'll leave that debate to others. But what I do know as an economist is that these people pull the rug out from under any wage gains for lower income Americans. So now Biden a separate policy said they want a $15 per hour minimum wage, federal minimum wage. That will definitely destroy jobs. There are plenty of businesses that, maybe they're happy to pay $8, $9 an hour, but they can't afford it at $15 an hour. They'll either reduce capacity or buy a machine. So $15 an hour will kill jobs in and of itself. But beyond that, the illegal immigrants don't care about the federal minimum wage because they're illegal immigrants. They're not supposed to be here. So what do they care about compliance with the minimum wage? They work for $5 an hour. Well, if you're an employer and you can get $5 help, why would you pay for $15 help? You won't. So it creates a new floor. But it's not just cheap labor coming over the border. It lowers wages for all Americans, because if you're here as a citizen and you're here legally, et cetera, and you're lower income, you're competing with those people for jobs. And if they're working for less, you're either getting less or not getting a job. So that will destroy jobs, drag down the economy. Well, the lower income Americans, it is true around the world, but certainly in America, have what's called a higher marginal propensity to consume. In other words, if I give Jeff Bezos $1, he doesn't spend it. There's nothing he wants that he doesn't have. So he can save it, invest it, he can do what he wants with it, but he's not going to spend it because you can't spend that much money. But for lower income people, you give them $1, sure, they're going to, buy a new washing machine or refrigerator or paint the kitchen, whatever it might be. Well, if you're hurting those people, you're hurting consumption. So, and US's economy is 70% consumption. So that's a problem right there. Now, the second thing is the Green New Deal. Biden has already announced they've terminated new leases for oil and gas exploration on federal lands. They're then going to move further to shut down existing drilling and existing output on federal lands for oil and natural gas and the fracking industry, destroy what's left of the coal industry. And again, I'm not here to debate climate change. I could. That's a subject for another day. But these are high-paying jobs. You're destroying hundreds of thousands, upwards of millions of high-paying jobs with benefits. Now, the talking point is, yes, too bad, but we're going to create really good green jobs. Well, I don't know what these green jobs are. Show me where they are. And I think you go to West Virginia and talk to a coal miner, and I've been to West Virginia, and I've spoken to people in the coal industry, say, well, aren't you ready to move to California and be a solar panel installer? Well, no, they're not trained for that. That's not an easy adaptation. Maybe they don't want to move. But the point is, this green job claim is a fantasy, but the destruction of jobs in oil and natural gas is real, and it's happening. So you're destroying, a million or more. And also, they shut down the Keystone XL pipeline, which would deliver energy from Alberta and Canada to Nebraska, which is a hub, and kind of get to the central part of the United States. That's been shut down again. Again, tens of thousands of high-paying union jobs. So they're destroying jobs left and right. They want to put on carbon taxes, CO2 emissions taxes, which will raise the price of energy. What does that do? Less consumption and on other things, and also cost jobs. So they're doing everything possible to destroy jobs, raising the minimum wage, opening the borders, shutting down fracking, shutting down natural gas, shutting down the pipelines, and more, and don't have anything to replace it. So that will be a major, major headwind for the U.S. economy. We haven't even got into monetary policy and deficit spending. Just to spend 30 seconds on those, I did another interview recently, and there's a major hedge fund, and they said, Jim, you follow the Fed closely. What is the Fed doing? What's your forecast of? I said, I do follow the Fed closely, and my answer is that they're impotent. They have no role. You can see what they're saying, but it doesn't matter. Rates are at zero. They're going to stay at zero as far as the eye can see. Money printing does not work because there's no lending and spending. There's no what's called velocity. So the Fed prints $7 trillion, gives it to the banks in payment for bonds, puts the bonds on the balance sheet. The banks take the money and give it back to the Fed as excess reserves. The money doesn't make it to the real economy. It just sits there. And so I tell people, you don't need to get beyond fifth grade in math. $7 trillion times zero is zero, meaning you can have all the money you want, but if you don't have velocity, you don't have an economy. And velocity, the turnover of money, the lending and spending part, is psychological, and it's out of the Fed's control. You've got to basically change inflationary expectations. And there's only one way to do that. And I talk about that at the end of my book, and that's to raise the price of gold.
Yes, well, I can absolutely guarantee you we will get to gold in just a sec. But just on that, I do want to talk about modern monetary theory in a little bit more detail, because this is something that's gone from, crazy fringe thinking to now, I'm reading about it on mainstream news and they're talking about it as if it's already here. But before we touch on modern monetary theory, Biden, I believe, is proposing a US $1.9 trillion stimulus package, which is, just to hand out some checks to everybody in America.
Right.
Will that have the stimulatory, well, assuming it gets passed, because I believe there's some resistance in the Senate to it, but will that
Right.
have the stimulatory effect he's looking at? Or is it going to do the exact opposite? And this comes back to your depression psychology. And are people going to hoard that money or simply just, pay the bills to have the roof over their head?
Right. It probably will happen. You're right about some pushback and some give and take in the Senate, but at the end of the day, it will happen and about that magnitude. Now, you refer to it as $1.9 trillion stimulus package. That's what the Biden administration calls it. I call it deficit spending. In other words, it is deficit spending. The money is going out the door. It's real money, but it will not have a stimulative impact. Why? The answer is that the money, at least to the extent it goes to individuals, $1,400 per household check, et cetera, people don't spend it. They're going to save it or they're going to pay down debt. But economically, paying down debt, paying down bills is the same as savings. In other words, you're shrinking your balance sheet. You're not buying a new car or a new refrigerator or new clothes or whatever. And the evidence is there. The U.S. savings rate has skyrocketed. If stimulus programs work, then why isn't the economy in better shape than it is? And in last April, the U.S. savings rate was 33%. Last May, it was still as high as 17%. And in June, it was still over 10%. Normally, 5% is considered kind of normal in the US, 8% is considered high. And now you've got these Chinese levels of savings, 33%, 20%, as the case may be. So what it shows is that just as money printing is not leading to any velocity, handing out money, deficit spending, in other words, is not turning into consumption. It's turning into savings. Now, savings individually, it can be a good thing. I'm not anti-savings. And certainly people, if you've lost your job, you're going to be saving. You're not taking your friends out to dinner. Even if you haven't lost your job, you're probably looking around. Maybe your spouse lost his job, or your neighbor lost his job, or you're thinking, well, I still have my job, but maybe my company will shut down next week. And so I'm going to save, even though I still have my job, I'm going to save just in case. Economists call this precautionary savings, saving for a rainy day, if you want to put it that way. And that's what people are doing. If you're out of work, you're saving. If you're not out of work, you're worried and you're saving. And so those checks will not have that effect. But on a more big picture level, what's going on here? There's very good evidence, a lot of it by a number of academics, that when debt to GDP ratios, what's the national debt divided by GDP? When that ratio gets to 90%, the Keynesian multiplier goes below 1. And the Keynesian multiplier says if you borrow $1 and spend $1, you can get $1.20 of GDP or $1.10 of GDP because of the turnover, because of velocity that we talked about earlier. And that's true up to a critical threshold, up to a level. And that level appears to be about 90%. Beyond 90%, what happens is the Keynesian multiplier goes below 1, which means now you borrow $1, you spend $1, and you get 90 cents of GDP, or you get 80 cents of GDP. In other words, you don't even get your dollar back. Now, what's happening to the debt to GDP ratio? It's a fraction, right? So as you borrow the dollar, the numerator goes up by $1. But if the Keynesian multiplier is less than 1, the denominator goes up by less than $1. So what's happening to the ratio? It's going higher, because when you expand the numerator faster than the denominator, the percentage goes up. Well, I said 90% was a critical threshold. Before the pandemic, the United States was at 106%. So we're already in trouble. Along comes the pandemic. So the denominator shrinks because we had a recession. The numerator expands because we've had multiple multi-trillion dollar bailout packages, the 1.9 trillion you mentioned. You're right, Shae, that's just the latest. We already had 3 trillion in 2020 and a $1 trillion a year baseline deficits and a $900 billion a year package last month. So you're looking at $7 or $8 trillion of debt over fiscal 2020, fiscal 2021. So pile that in the numerator. So now the ratio is about 130%. So who's at that lunch table? Well, it's Lebanon, Greece, and Italy. Those are your there's your lunch table. Those are the other countries, the super debtors that are in the same shape. And so, but what it means is that you cannot. So we're at a state now where you cannot print your way out of the crisis because of velocity, and you cannot deficit spend your way out of the crisis because the Keynesian multiplier is less than one. So you can print all you want, spend all you want, but you won't get any growth, or you won't get commensurate growth. And there's no way out of this. This is a death spiral that always ends in one of three places: default, inflation, or higher taxes. We're not going to default because we actually can print the money. So take that off the list. Inflation is a solution. If you inflate enough, you can melt the real value of the debt. Higher taxes won't work because that'll slow growth even more. So inflation is the only way out. The problem is central banks don't know how to get inflation. Although I tell the reader in the conclusion of my book exactly how to do it. Is a little recipe. You can do it yourself. But I don't know how many central bankers are going to read it and take it to heart.
That brings me to very quite neatly my next point, which is modern monetary theory. Now, this is where I absolutely urge everybody to get their hands on your book because of how you explain modern monetary theory in your book. But one key point that you make that I think is very powerful is that modern monetary theory is meant to alleviate concerns about the debt sustainability in the US. The thing is, it has the opposite impact of that. And as you said, it leads to much higher inflation for individuals. So, can you explain how you think modern monetary theory is going to be implemented in the US? And then we'll move straight on to gold.
Right. Well, it is being implemented. And whether people know the name or not, or for those who've heard of modern monetary theory, whether they understand it or not, is kind of irrelevant because we're doing it. And what's going on is modern monetary theory. Spend as much as you want. And there's no greater avatar for that than Janet Yellen. Because what does modern monetary theory say? Modern monetary theory says take the Treasury, in Australia, the finance ministry function, and take the central bank function, Reserve Bank of Australia, or the Fed, and merge them, treat them as a consolidated entity so that you can spend as much as you want. If you need to finance it, issue bonds. And if the market won't take up the bonds, the central bank can, by printing money, put them on their balance sheet, sit and wait till maturity, and life goes on. What's the problem? And the point is, when you present modern monetary theory that way, and that is the way they present it, it's a hard question to answer. Well, what is the problem? You have unlimited spending authority and you finance it with bonds, and the Fed can print the money to buy the bonds and sit on the bonds. And what's the problem? And so, but if you're going to merge the Fed and the Treasury, who better as a Secretary of Treasury than the former chair of the Fed? In other words, we've got the one person. If your theory is combine the two institutions, well, why not put one person in charge of one institution who used to be in charge of the other? So, I mean, it's almost as if Janet Yellen is like a modern monetary theory puppet who's been propped up there to do exactly what they describe. Now, here's so what are the flaws in this? The first one we already talked about, which is, by the way, when I criticize something, I really go to great lengths to read everything about it, so I, hopefully know what I'm talking about. And I've forced myself. It's like taking castor oil, but I've forced myself to read Stephanie Kelton's book. It's called the title escapes me at the moment. I have it around here somewhere. The debt trap, or the deficit trap. But the point is, it's a long book that spells out every tenet of modern monetary theory. So if you want to understand modern monetary theory, that's the book to get. Stephanie Kelton, professor of economics, State University of New York, Stony Brook campus. And I apologize, I don't have the title in front of me, but I think it's called the deficit trap or something. But anyway, but I read the book, and it's just painful. She actually goes so far as to say, well, we don't even need a bond market because the Federal Reserve runs the payment system, and if the government wants to spend money, they can just instruct the Federal Reserve to wire the money directly to the beneficiary. You don't even have to go through the process of issuing bonds and having the Fed buy them. And the way she describes it, the only reason we have bonds is as a favor to investors. We're doing them a favor, far from bankrupting the country. We're doing them a favor by giving them something to invest in, because we're pushing all this money out the door, and they've got all this money. And if you don't want to leave it in your bank account, you can go buy a bond. So we're doing you a favor by selling you the bonds, but we don't actually need them, because we could just have the Federal Reserve wire the money directly to Lockheed to build a jet fighter, or to individual bank accounts if they want to hand out money. And I thought, well, that's interesting. Having spent 10 years of my career at a primary dealer investment bank that was one of the major dealers in U.S. government bonds that dealt directly with the Fed, I never realized that the bond market was quite so superfluous. But that's how far they take it. So they say there's no limit on what you can spend, except for inflation, and you don't really need a bond market. It's a favor to investors, and the Treasury and the Fed can just spend what they want and send the money out the door. Well, it's kind of what we're doing. We haven't given up on the bond market. We still have those, but that aside, that is what we're doing. So what's the problem? The problem is the one we talked about earlier, which is that debt is not neutral vis-a-vis growth. Modern monetary theory would say, well, where would there be any money if the Treasury didn't spend it? Well, I used to think that you worked for it and you earned it, or you were creative, or you were an inventor, you were an entrepreneur, you just, whatever job you had, barista, it doesn't matter, that you earned your money. She said, no, you get it from the Treasury. We spend it. That's how you get it. And why do you need it? Why can't you repudiate the dollar? She says, well, because you have to pay taxes. And so we only accept dollars in payment of taxes. So you, Mr. or Ms. Dollar Slave, you have to earn dollars because we say so, because we're going to collect it in taxes. And if you don't pay us, we'll put you in jail. So it's very Maoist, power comes from the barrel of a gun. That's kind of what they're saying with the tax authorities as intermediaries. And also just philosophically, it sort of, it turns everything on its head. That's the easiest way to describe it. So you used to be that, yeah, the government issues the money. Okay, that's fine. But it used to be that it was the people's money, and the government had some right to tax some of it to pay for the government. That was, and you could debate how high taxes should be and what you should spend it on. Those were all political debates, but it was your money, and the government could tax some to pay for the government. But what Kelton and the modern monetary theorists say is, well, really, it's all the government's money, and we just sort of parcel it out to you because we think that's a good idea. And but we're going to force you to accept it because we're going to take it back in taxes, and you need it to pay us back. So it's highly socialistic, highly authoritarian. It's contrary to human nature. It will fail. It will fail partly for the reason I mentioned, which is the thing is, even if you don't have a bond market, I'm assuming the bond market's going to continue, but even if you don't have a bond market, a dollar bill is a form of debt. And just, I went to law school. They said, read the contract, take a dollar bill out of your purse or wallet and read it. It says note, in the U.S. Federal Reserve note. I'm sure your currency says Reserve Bank of Australia note, as the case may be. A note is a form of debt. Now, it may be perpetual non-interest bearing, but it's still a debt. And if you look at the balance sheet of the Federal Reserve, it's on the liability side of the balance sheet. That's where you put your debts. So there comes a time when that debt load gets so high, and this is what the ideologues always miss, and goes back to what we're talking about with lockdowns, adaptive behavior. They always assume that people are constant, they're locked in, and so we can manipulate them with policy to get them to do what we want. But what they ignore is the fact that people are highly adaptive. The minute you put pressure on somebody with policy, people say, well, how can I get around that? And that's the part they don't understand. And they say, well, you have to have dollars because you owe it to us in taxes. To an extent, although there are plenty of legitimate ways around taxes. But that's where gold comes in, because gold is an alternative to the dollar. If the euro is not much of an alternative to US dollars, or Australian dollars for that matter, gold is. And so if you buy gold and it goes up, you don't owe any taxes. If you sell it, you do. But if you just buy it and hold it and it goes up a lot, it goes up by a factor of 10, you don't owe any taxes on that. The dollar can come and go, and you've got a form of wealth, you've got a store of wealth that's going up in value, and you don't owe taxes. So you've sort of opted out of the MMT world while they go down this, driving the bus over a cliff. So it won't work. It'll fail for those reasons, but it is being tried, and it's going to be more in vogue because show me a member of parliament or Congress who doesn't like spending money.
Yeah, they don't exist. All right, that brings me. Yeah, that brings me to my final question of the day, and it actually is about gold. Now, gold, the spot price has seen a physical pullback. Now, one of the things I love about your commentary is that you don't get too much into the short-term price movements of gold, and I think that's really important for investors because it's too easy to get caught up in whether gold moved $10 or $1 in a day. But as you make the case for in your book, it's not a short-term way of opting out of the US dollar. It's a genuine alternative form of wealth.
Right.
So how do we reassure investors that are just coming to gold as an alternative form of wealth? How do we say to them, let's move on, let's move away from the short-term movements in gold and let's look at this big picture? What do you say to investors?
A couple of things. Number one, when people say, will the dollar get stronger or weaker? Well, I always say my answer to that is compared to what? Now, what most people mean is they're looking at the Bloomberg Dollar Index, the DXY, the Fed has a dollar index. There are a number of indices out there, but they all come back to the euro. The US dollar is 60% of global reserves. The euro is about 25 to 30% of global reserves. So those two currencies together are kind of between 85 and 90% of global reserves. So they're the whole picture. I mean, Australian dollar, Canadian dollar, sterling, they're important currencies. They're sound currencies, but they're not that big a piece of the big picture. It's pretty much euro dollar. The euro US dollar cross rate is the only rate that matters. And it's the rate that drives all these indices. And it's range bound. I mean, currencies don't go to zero, not major reserve currencies. And they don't go to the moon. So Apple stock can go to the moon. Hertz stock can go to zero, but currencies don't. They trade in a range. And so they're back and forth. The way you make money in currencies is to spot those turning points. But the euro US dollar cross rate doesn't really tell you very much about the US dollar because they're all in the same boat. There's not going to be a world where the US dollar collapses and everyone says, get me the euro. That's not going to happen. It's going to be a world where they all collapse together because there's an exodus from central bank currencies into something else. And it could be energy, it could be commodities, but the number one choice would be gold. And so if you want to know if the dollar is stronger or weaker, look at the dollar price of gold. That's like putting the thermometer in the patient's mouth, or I guess use scans these days. And first thing a doctor does is they take your temperature. Do you have a fever or not? And then they go from there. Well, if you want to know how the dollar is doing, look at the dollar price of gold. Now, lately, it's been kind of range bound. Now, it goes down to 1790 and everyone gets all upset, and it goes to 1950 and everyone's euphoric. But right now, 1950 is kind of, there's a little resistance there on the high side. 1780 or give or take is a floor, a bit of a floor. And it's trading in a range, and the range is kind of centered around 1850, but it's getting narrower. And so I don't consider myself a technical trader, but I do look at charts. I think they're information rich, and I put some value on them. I think they have low predictive value, but they kind of give you a good idea where you are. And gold is going to break out. It's going to break out of that range. So the question is, does it break down or up? And we have what I call a classic asymmetric trade, which is the likelihood that it breaks up sharply and soon is much, much greater. That's the most likely outcome. What would catalyze that? What would cause that to happen? Well, the answer is lower U.S. interest rates. U.S. interest rates have gone up a lot in the past 60 days, 90 days, really. They're at a level where they're going to start to slow U.S. growth. And that's happening for other reasons, which we talked about earlier, including the pandemic. So when you hit that wall, what happens to interest rates? They come down a lot. And then that weakens the dollar and drives the dollar price of gold sharply higher. It's going to break out of the range and go up quite a bit. So that's the medium term forecast. Longer term, I mean, gold's on the low end, $10,000 an ounce, on the high end, $15,000 an ounce. Why? One of two reasons. Either this modern monetary theory prevails. It keeps going the way we described. There's nothing stopping it right now. And people just kind of chaotically lose confidence in the dollar. They're like, you know what? I don't have a PhD. I don't know what's going on here, but get me out of the dollar. And when that happens, they just flood into gold. The other way would be a lot more rational, which is that the central bankers would realize, going back to what we said earlier, and this is in my book in a lot of detail, that the only way out of the debt trap is inflation. The only way to get inflation is to change inflationary expectations. And the fastest way to do that is to devalue the dollar against gold. And it was done twice in the 20th century. Once by 1933 by Franklin Roosevelt, once in 1971 by our friend Richard Nixon. And both times they got inflation. Now, Roosevelt did it on purpose and knew what he was doing. Nixon kind of stumbled into it and didn't know what he was doing. But the result was the same in both cases. It was inflation. And that's exactly what FDR wanted. That's exactly what Roosevelt wanted, because we were suffering from deflation. And he said, how do I break the back of deflation? And he had a kind of commodity, a guy, totally non-mainstream commodities investment advisor. And he said, you got to devalue the dollar against gold. And the point is not to reward holders of gold. It will. If you own gold, you're going to benefit. But that's not the point. The point is to raise the price of everything else. So the world of $10,000 gold, or even $5,000 gold, I always say it's got to get to 5 before it gets to 10. The world of $5,000 gold, let's say, is also the world of $400 oil, $100 silver, $50 wheat. It gets the price of everything up to go up. That's how you do it. Now, that's not going to happen soon, but it will happen eventually, because central bankers will get the wake-up call, or people will take it there on their own. So it gets there either way. The only question is it chaotic, which is a mad scramble, or is it planned by central bankers? But either way, it has to go there, because you have to get out of deflation, or the debt's going to eat you alive.
Jim, that is an absolutely fantastic place to end our interview today. I hope people have listened to your wise words. Also, too, if you want more on what Jim has just explained, you really do want to get your hands on The New Great Depression. It is one hell of a read. I can assure you, you will enjoy it. And as I said, it's the first book of its kind to meld the pandemic and the economic situation that we are in. Jim, thank you very much for joining me from the other side of the world. As usual, it's a pleasure to talk to you.
Thank you, Shae.